Since we're also looking at the banking space and whether or not incremental stress will continue to rise for banks, management commentary has, of course, been cautious as well across sectors. Will the IBC's 330-day deadline speed up that process? These are some of the questions we're asking this morning. Mr. Srinivasan is joining us, Vetren Banker and Market Expert, right here with us in the studio. Mr. Srinivasan, thanks so much for being with us this morning.
Good morning.
Okay, lots of different management commentary coming out, which all seems to be incredibly cautious as well, whether it be across banks, FMCG, auto, the entire spate. Do you see further signs of the slowdown intensifying?
See, I think we met a couple of months back when I said the phase was not yet over. And I think clearly what we're seeing today is recognition of that in terms of saying that things don't look as good as what they sort of were painted to be. And I think reality is clearly sort of sinking in, which means most of the bad news is getting factored in terms of expectations as well as in terms of price action. And that's a good sign. So the whole thing is that now you're factoring in some of the things which you possibly were not 3-6 months back. And that's healthy from a point of view of saying how do we move forward. So the commentary which is coming through clearly is sort of dampening expectations. And I think you will see the bottom over the next 3-6 months. And the entire thing is going to be that the economy was never as good as what the GDP numbers seem to indicate, and that's what the actual numbers were saying in terms of volume data, and that is clearly reflected in the numbers. And I think clearly you're going to hit the bottom over the next 3-6 months, and from there I think it's time to sort of see how exactly you play this cycle upwards.
So you do see us hitting the bottom. You do see that bottom.
Yeah, I think right now you're possibly in the most pessimistic phase.
But does that mean a further strain on NPAs? When you say the bottom in 6 months, how much more pain?
I think you've got to differentiate between two things. One is in terms of the sentiment and mood will hit the bottom before actually the numbers do.
Wow.
So I think what you're seeing today is the sentiment, the mood, the despondency.
All at rock bottom.
All at rock bottom, which means that the worst case scenario in terms of expectations is being built in terms of what your expectations in terms of P&L is going to be, in terms of price action. Most of it is sort of now in your mind, you're playing for that scenario. The numbers will actually take some next couple of quarters to play through. But ultimately, you're going to see the bottom in terms of price as in terms of actual numbers over the course of this year. And hopefully, FY21 will be better. FY20, in my view, is a bit of a washout.
Yeah. Right, so it already has been. But what gives you that kind of confidence? And more importantly, what will it take for us in the next 6 months to really snap out of this gloomy phase? Would it have to be a combined effort, both by the RBI, to slash rates lower, along with the government, to maybe pump in some stimulus? Because this was being talked about at the budget time as well, that the government can maybe do away and, take that hit on the face, maybe provide some sort of stimulus, because the economy had already, showed those signs of a slowdown coming in. What will it take for us to snap out of this?
I've always maintained this is nothing which RBI can do. I think liquidity is abundant. Rate cycle, I think they've continuously cut rates.
But the confidence is missing. You've always maintained.
Basically, right. I think rates are not going to do the trick here. I think it's all got to do in the mind, meaning risk appetite in terms of market, people willing to go out and sort of put risk on their portfolios. Promoters willing to put risk in terms of putting out fresh capacities or going in for and building out assets and expansions. And clearly every stakeholder trying to say, okay, now I think things look better from here and I could generate a return which meets my expectations over the next 24-36 months. And that's the bottom which I think you will possibly hit over the next 3-6 months.
But sure, but on ground something has to change for sentiment to improve, right?
From a structural point of view, the demand situation in India is okay. Meaning, whether it's demographics, demand, nothing. None of us are not going out to sort of restaurants. None of us are not going out and sort of buying stuff. So I think you are seeing a correction in terms of expectations. If you are expecting consumption demand to be going at 20-25%, if you're going to correct that to 10-15%, and if that 10-15% is going to give you the right returns, I think you rebased it. So there's a bit of rebasing, re-rating which is happening right now, which is what I'm saying will happen, which is broadly happened to a large extent, and which will happen over the next 3 months. That's why I'm saying today I'm a lot more sanguine than what I was 3-6 months back, because boss, everyone is so bearish that I think you can't go worse from here.
Basically, risk prices are building in risk.
Most of the prices are already built in risk, except the fluffy ones which always was carrying the market. I mean, that the correction is what it was basically you had liquidity and it went into few pockets. And when liquidity is not there, those pockets need to sort of correct. And I think that correction will happen. I think that has nothing to do with fundamentals. That was a technical thing. So,
what are you making of the new IBC deadline? So many cases are pending, delays, overloaded. I can already see your expression.
I think ultimately it's all stakeholders need to take some decisions. I think the decision-making environment infrastructure is sort of missing. No, everyone is happy not to sort of make a call today. And I think unless that changes, whether you move from 270 to 330 or 330 to this, it doesn't make a difference.
Right. Also, just when you said that RBI, cannot do anything in the near term, whenever rates have come down and come down substantially over a period of time, what has been your experience in terms of demand for the loan? How do corporates react?
I don't think so. Demand for the loans is an issue here. I think it's a question of bank lenders' risk appetite. So if to some extent banks have money, I think they're happy putting it away in keep holding that liquidity rather than take risk. So you are going to give it to the least risky sort of borrower today and not do anything more. And I think if you have more liquidity, the credit spreads are going to come down. Even if MCLRs sort of come down, the credit spreads are going to widen, and therefore the lending rates to the people who need it is not coming down. So I think that's a risk appetite issue, and people need to be comfortable that I've seen the worst. From here, if I lend, I don't think so I'm going to be exposed to sort of incremental stress. And I think that's something which in their mind they need to sort of get comfortable with.
So we've been hearing this, and I think that's 2-3 issues we're looking at. So we've got the rate transmission, we've got the fears with regards to the NBFC's retail, real estate, retail, unsecured credit, as we were just discussing. On top of that, we've had this whole issue of the FPI tax. And, it's led to this complete outflow of about 12,000 crores in July. We've had a, horrible month that's gone by in terms of the flow picture. Do you think perhaps the regulators could have clarified this better at a time like this when we're already seeing, so many pain points and the government's been bandying the growth story? Did we really need this?
We surely did need this. And I think clearly it is sad sentiment. But ultimately, we need to get the basics right here. Meaning, some of these are technical in terms of if the return expectations sort of widen to 30%, the FPA tax will not matter. So, what I'm saying is, I'm sure people are affected. Less money will come in, not desirable. But there will be another set of investors who sort of fill in that gap because the return expectations are sort of good. So, the issue right now is where do we sort of see the bottom, and when do we see sort of growth coming back, and where do we see return expectations? Today, the return expectations right now are quite feeble, and I think the correction which we're seeing today will sort of, as it sinks in, and as sort of numbers sort of plateau over the next couple of months, meaning it doesn't go down further. Broadly, I think, and ultimately the government will sort of have to send signals that we care and we need to sort of do something to sort of flip this. And I think there would be something which comes through. I mean, I don't think so. What's happened over July, I can't expect it continuing for the next couple of months. Meaning then
then issues are much more than.
Then it becomes a vicious spiral. So you got to sort of, there will be a correction which comes. Ultimately, it will be an external action, a regulatory action or a government policy action which sort of flips it. But broadly, the momentum in terms of forming a base is sort of building in.
Sure. But are you not worried about this overall consumption slowdown? I know you threw in the example that you and I haven't stopped going to malls or watching movies, but we're not the real India. Let's face that. People are not buying cars. There are dealership showrooms which have, shut shop. We are seeing the slowdown when it comes to retail, consumption. Real estate has been in the doldrums. When do you see signs of recovery coming in there?
Say, basic thing, whether it's an individual, whether it's a bank, whether it's a borrower, whether it is a sponsor, I think it's a question of risk appetite. Meaning today, if you are going to say that I'm willing to spend X amount of rupees a month, and you cut it down to say that things don't look good, I want to spend 30% less, you got to go back to X at some point of time, saying now things look okay. And that broadly is an issue, is saying that how comfortable I am in terms of projecting the next 2 or 3 years and see that I'm comfortable, stable, and I'm secure. And I think that will happen. It's all. I mean, what I'm trying to say it is numbers matter, but ultimately, in your mind, when the risk appetite comes back, when you feel secure, a lot of these things will change.
So one part of the risk appetite is obviously sentiment, but the other part is also clearly, as you said, on the numbers. Given what we've seen so far from the earnings, from the banking cycle, given what we've seen on the NPA side, What would be your takeaway? Because you've just talked about how there could be further pain, and I want to get a sense, and I think markets want to know whether it's on the NBFC and the liquidity side, or whether it's in terms of pure NPAs that we're tracking with these banking earnings. Are there still deep cuts expected? What's the kind of quantum you're looking at?
I think from last September till at least till March, I think we were in denial mode saying it's a liquidity issue.
Yeah.
So now no longer people are saying it's a liquidity issue, because liquidity has come back, but still the problems remain. So we are really trying to say that this to some extent is to do with asset quality also, and how exactly that corrects, whether it is, and that we are seeing some of the numbers slowly indicate. And I would think those numbers would sort of next couple of quarters is where I would see some of these things sort of.
We had Ramesh Sopti come out and say he still expects to see a couple of NBFCs go belly up.
That's going belly up. What's the size of the NBFC? Exactly. What does it mean in front of the system? I think those things matter. You possibly wouldn't even know that the couple of NBFCs going bad every week, and it's not something which it's not something which hits the media headlines. It's not in the front pages. But there are a couple of guys who go down every week, I'm sure. So that's not any. I think ultimately it's a question of everyone feeling that I'm happy to take risks because I believe the worst is over, and whatever I do today, I would get I will get rewarded for that. I will get returns which is commensurate with the risk which I'm taking. Right now, people believe that the returns which I am getting today is not commensurate with the risk, but that will change
as things improve.
As things improve, as things go further down, I think it's see when you stock of returns, you are at place X and you expect 10% today, but if you're moving from X to X minus 10, you automatically the returns get 20%.
Right. So 10 plus.
So whatever. So you clearly have to. That's what I'm saying. So if you were expecting something in terms of returns from market from 1 month back to today, you are in a better place to sort of put that trade to work.
Okay, let me put this differently. Do you think the banks, because I think we've all been trying to push you for some actionable points or some silver lining, which is obviously not there right now, but in terms of how banks are trying to deal with the situation, whether it be with write-downs, extra provisionings, etc., do you think they're doing the best possible?
I think they are.
You're at least in terms of that.
I think they are. They are providing as much cushion, cover, buffers as possible for a scenario which can sort of turn more adverse than what actually is happening today. And that's a good thing, because you may not need all these buffers.
Sure.
You may not need all these buffers.
Sure. Okay. And would you be expecting to see further transmission? I know you said rate cuts don't matter, but we've got a policy meet coming up. Could that be, at least in terms of a signal, something that the markets would watch out for?
It's priced in.
It's
priced in.
I just wanted to understand about fundraising in banks. Now, when you were in your earlier role in the bank, a lot of fundraising activity was done. Can you just tell us how FIIs look at higher provisioning, how FIIs, look at banks coming down and, completely writing off their book before they give capital? Does capital raising become easier, once you give a guidance in terms of what are you expecting once you categorize the BB book for any large cap bank?
So I think no investor is going to come into any asset if they believe the balance sheet is weak.
Correct.
Now, I don't think so. The P&L matters when you look at capital raise. You need to make sure that the balance sheet is strong and is credible. And I think as long as that is true, then the P&L is something which you build on, saying from here, what's the strategy and how do you build the business and what sort of returns you can anticipate. And that, I think, that is something which you can re-engineer based on what the outlook is and what the skill sets of the bank are and how exactly you approach it. So for starting point for investors, you need a strong balance sheet. So therefore, if you are provided enough and if you have credible numbers, clearly that's something which the investor is going to be happy with when he comes in. But if that's not the case and you believe something else could be lurking around the corner, then clearly that's going to hold them back.
Okay, Mr. Srinivasan, always a pleasure having you on the show. The last time you were negative, about 3 to 4 months back, we were taken aback. Now with your positive sentiment also, we're taken aback. I hope you're right this time too. Thank you so much.
Yeah, I think, as I said, more than policy and regulatory action in terms of liquidity rates.
It's the sentiment.
It is ultimately where you believe the bottom is, and I think it's more behavioral than anything else.
Yeah, and that is what the market is.
Yeah.
Okay, great to have you on the show.
Thank you.
Thank you so much for joining in.